Hello friends, in last quarter we have seen fixed income market moving in a range with 10-year moving from almost 710 to 740. It made a low of 710, 715 when actually JP Morgan announced the news of Indian sovereign bond inclusion into JP Morgan emerging bond market index. Along with that, we saw some movement at the shorter end of the curve, especially the money market curve, the 1 year and the 3 months. The 1 year moved up by almost 50 basis point, and the 3 months also moved up by close to 25 to 30 basis point. And mainly this was on account of Reserve Bank of India resorting to different kind of liquidity reducing measures. Along with this, on the global front, we have US Treasuries in the 10-year and the 2-year moving up by 150 basis points respectively on geopolitical news and also on monetary policy announcements in these countries. We have seen US Treasury moving up from 4% to 5% and the 2-year US Treasury moving up from 475 to 5 quarter, and as we speak, it's again down to almost 460 levels on the 10-year and 485 levels on the 2-year. As far as crude oil prices are concerned, we saw the recent geopolitical escalation resulting in crude oil prices moving up to 96. And right now, as the issue goes on, we have seen prices again settling down to say around $85, $86. There are various parameters due to which this movement on the fixed income market happened. One of the major movements was JPM bond inclusion, which actually resulted into markets going down to around 710, 715 levels. JP Morgan included Indian sovereign bonds into its emerging market index, which stands today at almost US dollar 250 billion. And JP Morgan allocated 10% to Indian sovereign market, which would result over a period of time into inflow of close to $25 billion. Along with JP Morgan, if other indexes like Bloomberg and FTSE also decides to add India in its index, then it will result in more outflows. This will not only result in yields coming down over a period of time, but it will also have positive ramifications on the INR as well as the current account deficit. From a geopolitical perspective, we already witnessed some issues going on in the Russia-Ukraine side, and to add to it, recently we had issue starting on the Israel-Palestine front also, which is in the middle of Middle East, which is the oil producing region. So if this issue escalates further, we will have logistics issues and supply chain issues as far as global commodity markets and crude in specific is concerned. On the global growth front, IMF has already projected almost 3% growth in FY23. As we get into FY24, the IMF projection is less than 3%. And there are three major reasons which IMF has cited for a lower growth in next financial year. One is obviously your services growth, which has been vibrant for last 2-3 months, is tapering down. Second is the tightening financial conditions, which is a result of continuous rate hikes by global central banks. And third is basically the escalation on the geopolitical front, which will lead to all the global economies, including India. On the global inflation front, we have seen inflation peaking in the middle of this year, and then because of rate hikes and other measures by the central banks of various countries, we have seen inflation coming down from the higher level, but certainly it has not reached the threshold points of majority of the central banks. It is acting sticky as of now. And to add to that, we have the current geopolitical situation, which may or may not impact the global inflation as we go ahead. Coming back on the domestic growth front, clearly there is a good amount of vibrancy as far as domestic growth data goes, be it auto sales, be it GST collection, or be it your PMI data. All has been vibrant, and that's the reason why international agencies like IMF and local central bank like Reserve Bank of India both are quite positive as far as your growth goes. From a domestic inflation perspective, couple of months back we actually saw inflation into India rising above 7%, and the main reason for that was basically rising of the vegetable prices. But as monsoons recovered, we saw vegetable prices coming down, and thereby other parameters also helping the headline inflation to come down below the previous levels. Even the weaker monsoons, which led to some cereal prices going up, was compensated by falling vegetable prices, and which resulted in your headline coming to near RBI projection. One of the startling features of last quarter was reduction in the liquidity due to various measures and the intention of our central bank to keep liquidity at a neutral to negative levels, which resulted in money market yields going up. You have already seen the overnight rate, which was around say 6 half levels, going up to 675 levels because of this liquidity measures. And in the recent policy, Reserve Bank of India announced one more tool to handle liquidity going ahead, which is OMO sales, which can be used whenever liquidity goes into the surplus mode. We can see RBI using open market sales operations to control liquidity in the market. From INR USD perspective, we have seen gradual depreciation happening in INR. In fact, over last couple of months, INR USD has been quite stable. Though there are some geopolitical disturbances, we have seen a very stable movement as far as INR USD concerned. And if you have good amount of inflows as we go ahead in the bond inclusion, and various agencies they include Indian bonds into the global bond index, we will see some positive movements as far as INR USD is concerned. Finally, we are quite constructive as far as our view goes. We are running medium to higher duration in most of our portfolio, which construes the core portfolio of the allocation. And from a tactical perspective, we are trying to take benefit of the short-term movements in the market, which does not change the basic nature of the portfolio. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.